Jurrien, welcome. Great to see you.
Good morning, Pamela.
So things are moving very, very quickly, and Friday was a wild day. We used to sort of ask what could be a catalyst. There are so many catalysts now. You would never ask that question at this point. There's just catalysts beyond the eye can see. What do we do with them all, especially when we're watching the market sell off?
Yeah, no, it's been chaotic, right? We're only 4 weeks into administration. We're 6 weeks or so, 7 weeks into the year. And as much as the news flow has been hard to keep up with, the markets are sort of in a holding pattern, right? So a lot of it's, there's an old saying, buy the rumor, sell the news. Well, it's been buy the rumor since the election and wait for the news and trying to figure out what is news and what is real or what is not. Um, what is a negotiating ploy? What is four-dimensional chess, in terms of the political environment? And it's clearly a strategy by the president to create sort of a sense of chaos, if you will, that you overload the system with so much news flow or data that no one really knows what's real and what's not, and that keeps your adversaries sort of looking for direction. And I think the market sort of caught up in that. And it's if normally you have a bell curve distribution of outcomes, right? And you're kind of like if the middle is neutral, most of the time we're looking at, okay, what's left of neutral, what is right of neutral. In this case, I think you have to go all the way to the tails, right? And so the argument can be made that what's happening in Washington and around the world could be good, right? I mean, maybe the world grows stronger out of this. And we saw the election in Germany yesterday going from, center left to center right, not hard right, but center right. And maybe Europe is waking up to, the notion of we need to grow faster to get to keep up with the debt or spend more on defense. So European stocks all of a sudden are running, but it's sort of this roller coaster ride. And the old saying by one of my favorite authors, Joseph Campbell, is you gotta break a few eggs to make an omelet. And I think the market is sort of they went in after November. You look at the fund flows, which I don't have today, but if you look at them, very, very strong inflows. So the Trump trade was being bought up, but now we're in February, and I think the market is sort of hanging on this roller coaster ride. And if you're in, you don't really want to sell because what if it all turns out okay, or even better than okay? But at the same time, if tariffs are not a negotiating ploy, but the start of a stagflationary trade war, well, that's not good, right? Then you have less growth and more inflation. And so I think at this point, the market is just, okay, we're hoping for the best. And like you said, the equal weighted index, which I'll show you on slide 2, it made its high in November, and it's been sort of trading sideways, and 52% of stocks are above their 50-day moving average, and 62% are above their 200-day moving average. So there's a lot of churn going on. And this is not a great chart, but it's not a terrible chart. And so that's mid-November. And if we go to slide 1, the Mag 7 hasn't made a new high since December. And so again, that's not terrible. I mean, the market can't always go up. So price discovery goes in lumps. And right now, the market doesn't really know what to make of the price discovery. Right. Is there something to discover or is there not? So I think we're kind of there, and there are some interesting parallels to 2017, which was the Trump 45. And if we go to slide 10, I'll show you the U.S. dollar, which obviously everyone in the audience is always very interested in. But even there's some parallels, right? So the dollar. So part of the Trump trade, at least as it's perceived, is stronger dollar, unleashing of animal spirits, of tariffs, which tends to might favor U.S. markets over international markets, but it doesn't always turn out that way. And in 2017, you can see in the box there, the dollar peaked on January sixth, if I'm reading my own writing
I think that's
correctly.
right.
And then it went down for a year. And right now the dollar peaked on January 17th, and it's slightly down, not a lot. So it's interesting how what seems obvious often isn't. And knowing what's going to happen next is one thing, but it only gets you so far because you also have to know what's been priced in. And so far, I think the message is that quite a lot has been priced in, and now we have to just see how the cookie crumbles.
Do you feel that there is new leadership within the equity market at this stage? I mean, the deregulation story seems to be a bit of a guiding feature for a number of different sectors that did not have that, before Trump was elected this second time round. So is there new leadership partially based on deregulation?
Yes, and if you look at the financials, they've been on a tear. And even before the German election and before European stocks started trading off, and we can pull up slide 3 here, um, the European banks were already, kind of getting on fire a little bit. So this is part of yield curve steepening. It's part of, central banks being done raising rates. But I mean, look at the MSCI Europe. I mean, that's a great looking chart. And frankly, uh, I'm so far being proven wrong that a global rotation can only happen if the Magnificent Seven give up the ghost, if you will. And I'm very happy to be proven wrong because I know a lot of people, including my colleagues, are positioned for rising markets, so the beta side, and they're also positioned for better performance from international markets relative to the US, and that's the alpha side. So my sense is that if the alpha is going to work global versus US, then the beta is not going to work because the Mag 7 are so top heavy that if they get rotated out of, they'll drag the markets down. And so you only get the alpha and not the beta. Right now, there isn't much beta, right? The US markets are kind of in a holding pattern, but the alpha is working, right? The MSCI Europe is up 9% year to date. Emerging markets 5, 6, and the S&P is up 2.2. So happy to be proven wrong on that side. Whether it lasts or whether it's just a trade, obviously remains to be seen. But within the U.S., the financials have really stolen the show here. Their earnings have been good. And remember, while we were always fretting about Fed rate hikes and inverted curve and historically how bad that is for financials, which historically it has been because it inverts the net interest margin for banks, and then they don't lend anymore, and then you get a credit crunch, then you get a recession. This time around, bank deposit rates never caught up to the overnight lending rate, right? So even as the Fed was at 5 3/8 at its peak, the big banks were paying 0.5% on their deposits. So the banks never really had an inverted curve unless you were maybe a smaller community bank, but the mega banks certainly did not. And now with the back end rising and the front end coming down, you even get more fuel. So that's kind of the leader right now in the US and globally. I think Europe, and we all know the story, right? President Trump has put NATO on notice that the U.S. may not defend them. They're now buddies. Putin is now buddies with Trump, and I think that in many ways is terrible. But that's not my place to even have an opinion. We got to figure out what it means for the market. So if Europe all of a sudden starts spending on defense and infrastructure and supply chains because it has to compete and it has to bring its defense spending from 2 to 5%, you can see what happens to the defense stocks in Europe and to the European stock market in general. And then on top of that, you've got the story in China, which is slide 4. I think it's no coincidence that last week there was this meeting with Xi Jinping and Jack Ma of Alibaba was in the room. A month after we had the inauguration in the U.S. with all the tech bros in the room, and so maybe all of this upsetting of the world order financially and geopolitically puts a little bit of a light under people's behinds around the world to be more pro growth as well. And so maybe election in Germany with the center right now, the CDU winning. Maybe that's another example of that. So that's kind of the glass half full way of
Yeah.
thinking about it. It's sort of move fast, break things. This seems to be the motto in Washington, and I've heard it likened to, are you going to hire Boeing or SpaceX to build your aircraft? And and I think that's sort of this hyperspeed mode we're in, and when you move fast, things will get broken, right? And you hope that with the Doge chainsaw
Yes.
coming down, that it's only the wasteful stuff that gets cut, but not a lot of collateral damage in addition. And I think that's kind of what we're all waiting to find out.
A lot of ink was spilt this weekend over the so-called Mar-a-Lago Accord, which was broken on Friday, I think by someone you know well, Jim Bianco. This is just broadly allies kind of paying for the defense protection they get from the U.S. via trading in their treasuries for ultra-long bonds. That would be a shakeup to the way things are run. What do you make of that?
Yeah, no, it's some really great thinking by Jim. I've known him for 4 decades, um, and it's interesting. It may not happen, but what Jim correctly points out, that with this administration, no status quo is safe, right? Geopolitically, financially, economically, everything is on the table, and he is not afraid to break some eggs to make that omelet, as I just said, and hopefully it's an omelet and not a bunch of messy scrambled eggs with eggshells in them. But what he's suggesting is that this is a new form of mercantilism, and if you're a trading partner and you don't want to get taxed through tariffs, then you need to agree to buy century bonds that you can never sell. Now, again, I don't no idea if that's going to happen, but the way of thinking about it, that nothing is sacred, or no status quo is safe from disruption. I think that's a very good way of thinking about it, that everything is on the table. And so I don't know if that's going to be the bargain, that, if you're a trading partner, and obviously this world order we've been in really since Bretton Woods, in the 40s, is that the U.S. consumer, reigns supreme, and we've sent, jobs and supply chains overseas, and that's hurt obviously the people who have now voted for Trump, but it's also helped people by lowering prices and things like that. And so that way of mercantilism has been, we buy stuff from abroad, China, other countries, Canada. They earn the dollars from that trade, and then those dollars get recycled into our bond market. And so that's why our treasuries are owned. There are a lot of large foreign owners of that. Again, I don't know how the detail would work. Like, if they were to sell their tens and buy century bonds, then there would be selling pressure on the middle of the curve, or whether this is incremental, and how do you even keep track of this. So I'm not so concerned about the details or whether it even happens, but it was a good reminder that nothing is sacred right now, and the world order, as much as we've gotten used to it, can be upended in more ways than one.
It makes you wonder about the discussion of valuations, which was something that everyone started off the year taking a look at for lots of different reasons, and valuations abroad, and they were cheap and now they're getting a bid. But it's hard to know how things are priced in or not priced in right now. I mean, how do you value? Maybe that's why we're a bit stuck. We're not moving too much. But on the question of valuations, is sort of figure out where you go with things priced in or not. How much geopolitical upending is being priced, is able to be priced in?
Yeah, so if we go to slide 6, it's a great question. And ultimately, stocks are long duration assets, right? So if you look at a discounted cash flow model, you plug in 5 years of expected growth in earnings or cash flows or what have you. And then after that, you put in terminal value, which generally speaking is the long run growth rate in nominal GDP, which tends to be around 6% or so. So these are not short-term assets, and a lot of stuff can happen over the short term. But I think this chart is interesting because it shows on the horizontal axis the 5-year annualized uh, cash yield. So in other words, what are earnings growing? How much of those earnings are being returned to investor via dividends and buybacks? And then on the vertical axis, you have the forward PE. And what you can see is that the US clearly is the outlier, other than India, on the PE side. But unlike India, and India has its own story, and I'm not an India expert at all, but to me, what this chart says is that the US valuation premium has been totally justified by the fact that not only has the US outgrown the rest of the world in terms of earnings, but it's also returning about 75% of those earnings, again, via dividends and buybacks, whereas most other countries are at 50 or 60, and emerging markets are like in the 20s or 30s, which makes sense because EM companies tend to dilute shareholders because they're still in the growth phase. So, my sense is that valuations are appropriate, but then it's a question of what's the hurdle for the US in terms of valuations. Remember, the Mag 7 is trading at about 38, 40 times earnings. The broader market's trading at about 22. Ex-US, the world's trading at around 15 or so. And so will the rest of the world catch up on the growth side now that the world order is being shaken up? And I don't know the answer to that, but clearly we know from the Cape model that a high starting point creates a hurdle for the long term, right? So the current 10-year or 5-year cyclically adjusted PE has a strong inverse correlation with the next 10-year forward return. Now, 10 years is a long time, of course, but we can surmise from that model that the next decade in the US is going to be less robust than the last one. And if I had to guess as to why that is, and we've talked about the secular bull market, that we're in the 7th inning there, my sense is that will have to do with inflation and interest rates and kind of the unsustainable fiscal path that we're on, and that will lower valuations, even if it doesn't lower earnings. And then it's a question of does this gap that you see on this chart start to narrow? But again, we don't know yet. But right now, when you see Europe and China, for instance, and page 4 is the Chinese market, you can see that they can provide good amplifier effects when these trades do finally happen, and how long they last. Of course, that's the big question.
There's a lot of discussion around peace dividends, and again, these are unknown at this point, but they're obviously working for peace in a couple of different areas of the world in a new way. So Europe, when you think about even what Russia has to offer, who knows what that deal will look like, but I mean, it would affect things like the oil price if suddenly there was new oil available to the global market in a different way than it has been if certain sanctions were lifted. Is this part of an EM trade, or is this more of a European trade, actually?
I think right now it's a Europe trade, but the earnings have to follow through, right? So if we go to page 8. You can see the earnings squiggles for the S&P in the blue on top, and for the MSCI EFA index in the pink. And you have to kind of squint to see it, but you can see obviously how stagnant international earnings have been for so long. But the squiggles are kind of moving up a little bit, and whether that's dollar related or just the financials doing better, and of course international markets tend to be a little bit more financial and value heavy, it's a potentially good sign. So I think right now Europe, especially Europe, I think is in the hot seat because they're going to have to do something, right? If Putin and Trump become friends, Europe needs to fend for itself more, and that means more defense spending, shoring up supply chains, and even maybe drilling for more gas on their own. So to me, it's hard to make a bullish case for oil and gas because the supply is only likely to rise also in the US. But if we take the same chart and go to the next one, It's the same squiggles, but now for emerging markets, you can see how much weaker the EM side has been
Yeah.
than the EFA side. So to me, the China story notwithstanding, EFA I think is lower hanging fruit in terms of where do you want to be internationally than EM. But again, having said that, if the dollar is really, if it's peaked, and we don't know if it has, but it certainly has put in a short-term top, and it seems like nobody in the White House wants a strong dollar, then that could add some currency translation effect. And if we go to slide 7 for a moment, you can see the rate of growth in the forward estimates is
Wow.
perking up outside the US, while in the US, the earnings growth cycle seems to have peaked, by which I don't mean to say that earnings have peaked, they haven't, but the growth rate in earnings seems to have peaked. And just to illustrate in this chart here, how fast these things can change, right? The bottom panel shows the year-over-year excess return between the MSCI World ex-US versus the US, and the annual spread has gone from -16 to -7 in a matter of a few weeks. So that's how quickly mean reversion can happen, but it's a frustrating exercise because you don't know when it's going to start and from what level. And once it goes, it happens so fast you barely have time to keep up. But so that's my sense on international. Again, so far at least, I'm happy to be proven wrong that they can only outperform in a down market. I hope that is not the case because we want up markets and we want the alpha to kick in as well. And I'll just show you two final charts on
Sure.
this earnings side on 11. So why am I saying that the earnings cycle may be peaking at least on a growth basis? So this is a chart I've shown many times, of course. It's the contribution from earnings and the contribution from the PE side in terms of the bull market. And as we have talked a number of times, 23 was the first year of the bull market where price as usual leads earnings. So that year, all the action came from multiple expansion because earnings were flat to down. Then in 2024, the market was very strong, stronger than I had expected, because both earnings grew and the PE expanded. My sense a year ago was that 24 would be a year where the baton would get passed from the PE side to the E side, and that the E would have to do all the heavy lifting. And that turned out to be not the case. The E did a lot of lifting, but the PE really added to that. I think 25 is a year where that's no longer going to happen, that we have to rely completely on the E. And so if we go to slide 13, we can see that 2024 was a good year for earnings, up 11.4%, nothing to argue with. But the 25 numbers are starting to come down from 13 to 10%. 10% is still quite robust. So I don't think earnings are peaking in absolute terms. But my sense is that the growth rate is probably cresting here. And if that's happening while the growth rate in the rest of the world is coming off of lower levels and improving, then that maybe will be the catalyst for a fundamental support for a rotation out of the U.S.
Yeah, that is absolutely fascinating. And where does Canada fit in there? Are they in the global side of things, or are they more analogous to EM because of the connections to commodities?
Yeah, they're sort of in the middle, right?
Yeah,
I
in the
mean,
middle.
obviously, as a U.S. trading partner, the currency, the Canadian dollar versus the rest of the world currency, not the U.S., can do its own thing. But if the dollar has peaked, then the Canadian dollar should probably start to improve. But obviously, the tariff situation looms large. We still have a few weeks to resolve that. The EM angle that has always affected not only Canada, but like Australia and New Zealand, I think had more to do with the fact that in the last, 15 years or so, or 20 years, whenever China decided to stimulate, they would build things, right? And then you would need the raw materials and the natural resources. And of course, Canada is a huge provider of those. My sense is that in the current day and age, if China stimulates, it's not going to be with hard assets. It's going to be through whatever social support system or being more business friendly, which seems to now be underway. So I don't know how natural resource intensive it is if we get an uptick in growth, but obviously there's going to be some aspect of that. And of course, if the US is going to rebuild its supply chains and we do end up having a deal with Mexico and Canada like we did with the USMCA, then I think that rising tide should lift all boats.
A couple of questions here coming in, so let's see if we can get a couple of them to you. Do you think that the market volatility will cause President Trump to pause his tariff discussions? We hope.
Not at this point.
Okay.
So obviously Friday was a big down day, but the market is not really that volatile yet, right? So you look at credit spreads, very well behaved. You look at the equity risk premium, still at about 3.5%, bottom 10th percentile. You look at the VIX, it's at 15 or so. So if I were the president and I'm just looking at a screen of the major indices, like I'm not really seeing that much to be alarmed about, which I think gives him license to keep going. And so I think the White House or the cabinet is correctly focused on long-term rates because that really to me is the main indicator, right? Because if the term premium rises and it pushes long rates up to 5 or above, you have a fiscal mess because you gotta pay for all the debt that's already out there and the debts that still to come. And then you have the risk-free asset really competing with the equity markets for return. So keeping that yield down, I think, is sort of the main thing. So maybe they'll look more at interest rates or long yields than they do at the stock market, knowing probably correctly that one is going to drive the other. And I think the stock market is just, they've seen this movie before, right? The last time the world didn't end, which doesn't mean it's not going to end this time. But I think the market is just kind of, they're buckled up, they're on the roller coaster, they know it's going to be a bumpy ride, and everyone is sort of crossing their fingers.
Okay, you may have answered this question and exactly your answer there, but I'll put it to you. What is your perception that the U.S. perhaps will isolate itself enough from the rest of the world, given how certain leadership has upset some of their traditional allies? You may have just said it there, but yeah. A quick comment.
Yeah, we don't know, right? I mean, just because Zelensky is being overlooked and Putin is now apparently in charge, that doesn't, I mean, it's obviously very disruptive, but whether that's long-term disruption or whether other things come out of it, I mean, Europe will always be Europe. And in a way, like if the training wheels come off, that can be a good thing as disruptive as it is, because Europe is on an unsustainable fiscal path, right? And they are much less able to grow their way out or to keep up with the debt. Like the US is able to do it, but in Europe, like in Canada, everything is through consensus politics. Nothing gets done, and it takes like regime changes via elections, which is what we saw it in Holland recently. Now in Germany, you see it in Italy, and it's a slow-moving train. But ultimately, we're on an unsustainable fiscal path around the world, right? Not just the US, but Canada, Europe, China, Japan. And some disruption is maybe really the only way to try to break loose from that.
Okay. Fantastic to have you speak with us, particularly today and every day. Jurrien Timmer, thank you and have a great week.